The grain fleet is 3 weeks late at Portus, and the financier waiting on the mole has pledged his family estates against its cargo. Interest accrues by the month. No underwriter stands behind the hulls because in the Roman Mediterranean marine insurance simply does not exist. Over the next 8 minutes, the arithmetic resolves, 20 to 50% per voyage, priced against the total loss of hull and cargo. And every operator who survived it made the same final move, out of the water, into farmland. The question that governs everything after this: how does anyone assemble a fortune in a market with no mechanism to transfer risk? The demand side explains the appetite for that risk. Imperial Rome swallowed roughly 400,000 tons of grain every year. That figure only becomes legible when you convert it into hulls. Thousands of shiploads dragged season after season from Alexandria and Carthage. The capital, vast and endlessly hungry, held only weeks of buffer in its granaries. Delay the convoy, and the bread supply of Rome thinned out. The negotiatores who secured those supply contracts sat on the largest logistics choke point in the ancient Mediterranean, and they knew the leverage it carried. In modern terms, a guaranteed offtake agreement with a politically desperate counterparty. Rome could not afford to walk away from the table. A ship that survived the crossing paid its investors back with a margin no farmland in Italy could match. That margin created the financier's dilemma. For a finance audience, the arithmetic is plain. A 2-season round trip returning 20 to 50% per voyage outruns every land rent in the empire. Land paid a few percent a year, reliably, and it paid it to men who never watched a horizon for a sail. Those returns were not a skill premium. Nothing about a Roman shipmaster's competence generated 35%. They were a risk premium, priced against one outcome: the complete loss of hull and cargo in a single night. No underwriter absorbed that tail. No policy existed to write. The investor held the entire distribution personally from first payment to landfall. So Roman investors stopped betting on single hulls. They financed fractions instead, splitting one cargo position across several ships and several partners. 4 investors, 4 vessels, 4 separately sealed agreements. One storm off Cape Malea now removes a quarter of a position rather than the whole of it. That is diversification, built without probability theory, without actuarial tables, without any Latin word that means portfolio. The partners divided the freight, divided the risk, and divided the profit at return. Nobody outside the group absorbed anything, which caps the damage. It never removes it. Spread across 4 hulls, the tail risk is thinner and still sitting entirely on the investor's own estate. Splitting a cargo across 4 hulls caps a single loss. It does nothing for the merchant whose entire capital fits in one hold. So traders clustered into collegia, guilds that pooled resources, shared warehouse space, and traded shipping intelligence between members. For a trader too small to absorb one wreck, the collegium functioned as a cooperative credit line and a reputation register. That is the function no private contract could perform. It converted one man's ruin into a shortfall distributed across the whole network. The inscription slabs at Ostia's Piazzale delle Corporazioni are the physical ledger of a network that priced trust, because it could not price probability. The highest margin instrument in the Roman system never touched a ship. Syndicates of publicani bid hard silver up front at auction for the right to farm a province's taxes, then squeezed every denarius above that bid as profit. Whatever they squeezed out above that bid was profit, and enforcement came bundled into the contract. A publicanus arrived in Asia with ledgers, wax tablets, and the legal standing to seize a farmer's oxen, his grain, his children. That is the structure stated plainly, a leverage claim on a whole population's output, purchased at auction, with collection outsourced to the buyer. Collection parties moved through the countryside with armed escorts, seizing draft animals and pressing farmers into pledges against next season's harvest. The margins were extraordinary. So was the friction, because private extraction and provincial governance answered to opposing incentives, and Rome never resolved which one held authority. Trade was not the widest margin in the Roman system. Capital that financed provincial construction and mining concessions took the top of the range. Those ventures could return margins exceeding subsistence agriculture by 300 to 400%. The arithmetic rested on a single input: labor priced at maintenance cost. Enslaved workers hauled ore out of the shafts and washing channels at Las Médulas and Rio Tinto. Food, tools, replacement. No wage line ever entered the ledger, so almost the entire yield of the shaft settled out as return on capital. And the relationship held across the entire economy. Rome's highest returns sat wherever the labor input cost nothing but its own upkeep. Every successful Roman operator eventually moved the same direction, out of the water into the soil. Sea money became latifundia, olive terraces, oil presses, tenant contracts, and boundary stones cut into hillsides that no storm could reach. By the 2nd century, these estates formed the economic foundation of aristocratic wealth across the empire. The land was the destination, not the starting point. Read the trade in portfolio terms. A merchant surrendered an expected return near 35%, carrying the constant possibility of total loss. He bought a low single-digit yield with almost no volatility instead. And he bought something the sea could never underwrite: legitimacy. Roman fortunes were not built by scaling operations. They were built by surviving them long enough to exit. No joint stock company outlived its founder. No underwriter absorbed a sunken hull. No limited liability firewalled a merchant's personal estate. So compounding inside the business was never the winning move. The capital had nowhere safe to sit and grow. What worked was sequence. Extract the return, split the exposure across hulls and guilds, then convert the proceeds out of the water. Land absorbed the wealth because the sea could not reach it. Estates did not sink. Boundary stones did not default. Roman capitalism had no mechanism for perpetuity. Every generation of capital began again from the same uninsured exposure. Every fortune faced the same terminal choice: crystallize into dirt or evaporate with the hull that carried it. So every fortune restarted from zero. Crassus banked on freedmen he owned outright, not paper he could enforce from the grave. The wealth machine was one man's body, one man's name, one man's network, and all three stopped breathing on the same afternoon. Rome never assembled those instruments. No permanent joint stock shell, no traded public debt. So every venture stayed chained to the lifespan of the men who funded it. So the man waiting on the Ostia mole absorbed the entire tale himself. Margin was never his constraint. His constraint stood in front of him. Trajan's hexagonal basin at Portus, 32 hectares of dead calm water, and not one clause in Roman law that would move a single lost cargo off his own books.